Hello, I'm Bhoj Raj Pangeni. Welcome to the finance class. In today's lesson, we are going to discuss about the cost of capital. The capital means generally the fund, long-term fund used by the corporation. So the cost of capital means the fund, the cost of that long-term fund which is used by the firm or corporation. And generally in this video we are going to discuss only the numerical problem only. So the computation of cost of capital includes cost of debt, cost of preferred stock, cost of common stock, and the cost of retained earning. The common stock is new common stock, external source, and the cost of retained earning is the internal equity source. These four types of cost of capital, four types of capital structure we found generally in the corporation. So now where first of all we are going about the cost of debt. Let's say cost of debt. There are two types of debt. One is the irredeemable debt and another is redeemable debt. At first, the cost of irredeemable debt. Now the irredeemable debt is the perpetual debt or the debt which have no maturity period. That is called irredeemable. It cannot be redeemed at the maturity because it has no maturity period. It's a perpetual debt, so it is not redeemable. And there is no time period n, so the cost of debt before tax kd equal to I upon np, and the cost of debt after tax kdt equal to kd into 1 minus t, where cost of debt before tax kd equal to the cost of debt before tax and I equal to the interest amount, and the NP equal to the net proceed. Net proceed means either face value plus premium minus discount minus issue expenses, or NP equal to the selling price minus flotation cost, whatever the questions given us about the net proceed. And there is the cost of redeemable debt. Redeemable means that can be redeemed. Redeem plus able, redeemable, able to redeem by the company. And the redeemable debt refers to the debt which is to be redeemed or repayable after the expiry of the fixed period of time. Or we can say easily say, if in the questions the number of year or the maturity period is given, then we know that it is the redeemable debt because the debt is redeemed at the maturity period. So that debt in the question you can see, if the question is tells about the maturity period or time to maturity of the debt, so this is the redeemable debt. Now the KD before tax equal to the I plus M minus NP upon N divided by M plus 2NP upon 3. This is our approximate formula. And the KDT after tax equal to KD into 1 minus T, where I equal to the annual interest payment, that is the amount, not in percentage. You have to write in the interest amount, annual interest amount, and the M equal to the maturity value. Sometimes it will be the par value. Generally the par value is the maturity value. Sometimes the maturity value is higher than the par value. For example, if the debenture or bond will be redeemed at premium, then the value maturity value is greater than par value, so the M is maturity value. First of all you have to write the maturity value, or in the absence of maturity value you can write the par value. And the NP means net proceed of debenture or the debt, whatever we say, the net proceed means NP. As before in irredeemable debt, look at there is the NP formula. And the N equal to the number of years to maturity, or year to maturity, number of year, or whatever we can say. T is the corporate tax rate. T equal to the corporate tax rate. Now the second point is the cost of preferred stock. There are two types of preferred stock as debt security. First is the irredeemable preferred stock. I already told you that the meaning of irredeemable. So the irredeemable means perpetual or it has a no maturity period. So cost of preferred stock KP equal to PD upon NP. Here this formula is similar to the cost of debt, and the cost of preferred stock is before and after is same because it is the after tax cost of preferred stock. Do not write 1 minus t here because the dividend PD means preference dividend amount is always written in after tax because dividend is distributed after tax profit. So this is the after tax. Already the dividend is obtained by deducting the tax from the company's net profit. So PD means already it has the tax is deducted from the net income. So the PD upon NP is already a after tax cost. And the NP means the net proceed. The formula is same for the net proceed. Now the another is the cost of redeemable preferred stock. As before the cost of debt, we can say the cost of redeemable preferred stock. Redeemable means refers to the security which is to be redeemed or repayable after the expiry of fixed period of time, that is maturity period of time. This formula is similar to the debt. We can put the PD instead of I because the cost of debt is interest and the cost of preferred stock is preference dividend for the company. Dividend is cost for preferred stock and the interest is the cost of debt. So we can put the PD in the place of interest I, and the formula is same. Now where PD equal to the preference dividend, it is the PD means the not total amount, it is the preference dividend is per share preference dividend. Be consider about that. NP net proceed of preferred stock and N number of years to maturity. Now cost of retained earning KS. Cost of retained earning. Retained earning does not have a flotation cost because it is the internal equity fund. Retained earning is the internal source of common stock. Retained earning is the shareholders fund. It is the shareholders fund, retained earning, and it has no flotation cost because there is no underwriter cost because the company should not pay the dividend. Now Ks equal to the D1 upon P0 plus G. This is the Gaussian model of pricing the security, and or D01 plus G. D01 plus G is the D1 upon P0 plus G, whichever formula. Where the D1 is expected dividend, P0 is selling price of common stock, D0 is the last year dividend, past dividend, just paid dividend is our D0, and the D1 is the expected dividend, future dividend that we are going to receive in the future period of time, that is D1. And the G is here the constant growth rate of dividend or earning. We can say the constant growth rate of earning, whatever the growth rate, constant growth rate. So the value of D1 is depend upon the D0 into 1 plus G, that is the finding the value of D1. If the question asked by giving the D1, then you can put the first formula. If not, then use second formula. Now the cost of new common stock that company going to issue the new share of stock. So if company goes to issue the new share of stock, then it has bear the flotation cost, that is underwriter cost, investment bankers cost, whatever. And also known as the external equity. New common stock is also known as the external equity or external source of equity fund. Now ke equal to d1 upon np plus g. Here np d0 1 plus g upon np plus g, where np equal to the net proceed equal to the selling price minus flotation cost. Consider this formula very much, p0 minus f. As before cost of retained earning there is divide by p0, but here the cost of new common stock here is divide by np. np means p0 minus f. So there is a bit difference in formula, otherwise the formula is same. Retained earning doesn't have a flotation cost, so there is no flotation cost in the formula, but new common stock has a flotation cost, so we have to deduct it from the selling price. P0 minus flotation cost is our NP, or we can directly put the NP as a P0 minus F, whatever the formula you like. And now weighted average cost of capital. Weighted average cost of capital WACC equal to WD into KDT, WP into KP, Ws into Ks, We into Ke. Here the W is weight of capital, WD means weight of debt, into KDT means cost after tax cost of debt, plus WP means weight of preferred stock, into KP means cost of preferred stock. Ws means cost of internal source retained earning, and Ks means cost of retained earning. We means weight of common stock, and Ke means cost of new common stock. Here the way W means the weight of capital into, so the WACC is the sum of the product of weight into its specific cost of capital. So the weighted average capital can be computed from this formula. Now it's time to solve one question. The BR company reported to rupees 4.2 million last year. This is the earning, last year earning. From 4.2 million earning, the company paid a dividend of rupees 1.26 on each of its 1 million common stock outstanding. Now from this information, 4.2 million is the earning, last year earning, and 1.26 is the last year dividend, that is D0 last year, because the dividend is paid from the last year earning, so it is the last year dividend. And the 1 million is the common stock outstanding. And the capital structure of the company includes 30% debt, that is the weight of debt, and 10% preferred stock, that is the weight of preferred stock, 30% retained earning, that is the weight of retained earning, and the 30% common stock, that is the weight of common stock. And it is taxed at a rate of 40%. This is the corporate tax. Now part A, if the market price of stock is rupees 40, that is P0 equal to 40, and the dividend are expected to grow at the rate of 6% a year for a foreseeable future, that is G, constant growth rate 6%. What is the company's cost of financing with retained earning? Retained earning Ks equal to what? And the B, if the flotation cost on new issue of share of common stock amount to rupee 1 per share, what the company's cost of new common stock financing? New common stock financing means external source, Ke equal to what? Rupee 1 is the amount of flotation cost F. And C number point, the company can issue rupees 2 preferred stock dividend for a market price of rupees 25 per share. Rupees 2 is the preferred stock dividend per share, and the market price of preferred stock is rupees 25 per share. Flotation cost would amount rupees 3 per share. this is the flotation cost of preferred stock only. What is the cost of preferred stock? Have a look on the preferred stock. There is no maturity period, so it is the irredeemable preferred stock. Be consider which formula you have to use. It is decided by the time or maturity given in the question. Here is no maturity, so you can use PD upon NP as a formula. Now number D, the company can issue rupees 1000 par value 10% coupon 5-year bond. Oh, here is the 5-year is the maturity period. Maturity period is given, so it is the redeemable bond. Again, the company can issue rupees 1000 par value. This is the par value M. 10% coupon, that is the coupon interest rate, and the coupon interest rate is 10% given. The coupon interest amount is 10% of 1000, that is 100 rupees. And 5-year is our number of year maturity, year to maturity, that is N equal to 5-year. That can be sold for rupees 1200 each. That is the selling price of bond. Selling price of bond. What is the approximate cost of capital? There is no flotation cost, so the approximate cost of capital KDT equal to what? And the number E, what is weighted average cost of capital from above cost of capital? First of all, we have to write the given information. Earning of last year DPS D0 equal to 1.26, common stock outstanding 1 million, weight of debt WD 30%, weight of preferred stock WP 10%, weight of retained earning WS 30%, weight of common stock WE 30%, corporate tax rate T equal to 40%. This is all are given in the question. So the market price of stock P0 equal to 40 in part A. The price of stock, currently selling price or market price of stock P0 equal to 40, and the growth rate G equal to 6%. The cost of retained earning KS equal to what? We know that cost of retained earning KS equal to D0 1 plus G upon P0 plus G. Put the value of D0, G and P0 in the formula. We can easily calculate the cost of retained earning. 9.34% is our cost of retained earning. We can easily compute by putting the value from given information. Now it's time for number B, flotation cost on new common stock F equal to rupee 1. Then the cost of new common stock KE equal to what? We know that KE equal to D0 1 plus G upon P0 minus F. P0 minus F is NP. We can say NP equal to P0 minus F. And put the value of all the variables. D0 equal to 1.26, 1 plus 0.06, growth rate. Don't write the growth rate at 6%, directly 6 value. That is 6% is 6 divided by 100, that is 0.06. Divide by 40 minus 1, 40 is P0 and 1 is the flotation cost, and plus 0.06 is the growth rate. Please don't write the growth rate plus 6 whole number. Now this is our cost of common stock. Now it's turn the C, dividend per share of preferred stock PD equal to rupee 2, and the market price of preferred stock PS equal to the rupees 25. Flotation cost F equal to 3 per share, and the cost of preferred stock KP equal to what? We have KP equal to DP minus NP. This formula is used because this is the redeemable preferred stock. So no, this is the irredeemable preferred stock because it has no maturity period. This preferred stock does not have any maturity period, so it is the irredeemable. It cannot be redeemable, so it is the irredeemable preferred stock. So we can use this formula. and put the value of PD, and NP is the market price of stock minus flotation cost is our NP value. So PD equal to 2 rupees, PS equal to 25 minus flotation cost 3, that is called the NP. Now we can get a 9.09% as the KP, that is cost of preferred stock. Now number D, par value of the bond M equal to 1000 rupees and the coupon rate is 10%. Maturity period N equal to 5 year. Here the maturity period is given, so this is the redeemable bond. This is the redeemable security because it has a maturity period, so this is the redeemable. So use the bigger formula. Selling price SP, or we can say P0, whatever. Selling price SP equal to 1200 or 1200, and approximate cost of debt KDT equal to what? Now interest amount I equal to 10% of 1000, that is rupees 100 is our interest amount, and the net proceed NP equal to SP minus F. Here is the flotation cost is not given in the part D for bond, so we can put the 0 value as a flotation cost, and rupees 1200 is our net proceed. If flotation cost is given in the question, we can put the value of flotation cost in place of F. Here the flotation cost is not given, so we can put the value of flotation cost is 0. Now the cost of debt before tax KD equal to I plus M minus NP upon N whole upon M plus 2 NP upon 3. Approximate cost. Put the value of I, M, NP, N respectively, and we can get and compute. We can get 5.29 as the before tax cost of debt. After that it is not a completed, it's not complete. The cost of debt after tax KDT equal to KD 1 minus T. KD is already calculated 5.29 into 1 minus tax. 1 minus T means 1 minus 0.4. Don't write 1 minus 40. 40% means 40 divided by 100. That's why 0.4 is our tax rate. 1 minus 0.4 equal to 3.174%. That is cost of debt after tax. Now point E, weighted average cost of capital. Weighted average cost of capital WACC. Write the formula WD, KDT, WP, KP, WS, KS, WE, KE value. All the variable value are in our question and our solution. So put the value respectively. WD, WP, WS and WE are given in the question. Look at the given information, and KDT, KP, KS and KE are just you have calculated. So put the value and get the WACC as 7.4893%. That is the complete answer. Now you are requested to share and subscribe the channel for upcoming video. Thank you.